All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is August 5th, 2026. And our top story this morning, I think this one, for now, is flying under the radar in most of the financial press. But I think this is by far the biggest story in finance by a huge margin. Texas Governor Greg Abbott has just ordered a moratorium, a temporary pause, if you will, on approvals for new data centers in Texas. All right, that is now the second state with a moratorium on data centers. You've got deep blue New York, and maybe not as red as it used to be, but still pretty red Texas. You've got a screaming lefty governor and a screaming righty governor, both of them banning data centers in some very big, very important states, in particular Texas. Texas, with the exception of Virginia, Texas is ground zero for the data center build out here. And now they're basically saying because Texans come first, because the ERCOT power grid is a isolated grid for the state of Texas, they just cannot absorb all of these planned data centers, and it's not even close. And guys, I think we've gotten a little ahead of ourselves here, maybe just a smidge ahead of ourselves. Math gets a vote, and in this article, I think we all know there are power problems with the AI build out. But I feel like a lot of you guys are failing to kind of take the walk with me on just how big this power problem is. For example, in the state of Texas, the entire ERCOT power grid, its record peak demand was 91 gigawatts of power. All right, 91 gigawatts. That's a lot of power. Texas has a very big power grid. Right now, as of today, there are proposals for 474 additional gigawatts of new data centers to be built in Texas. The whole freaking grid, 91, they want to build 474 gigawatts of demand. Come on, guys. They're never going to build this stuff. Math gets a vote. You cannot power a data center with good intentions. I don't care what some a-hole in a tech podcast wearing a turtleneck tells you about how he vibe coded Microsoft Paint over the weekend. It doesn't matter. There's no juice. And they're not going to build it. You don't quintuple the size of the Texas power grid in 1 year just because NVIDIA's got to hit their freaking numbers. It doesn't work that way. 474 gigawatts? Shut the hell up. Come on, guys. They're never going to build this stuff. I cannot be the only one who's looking at this and saying, F you, go home, you're drunk. Oh, but don't worry. They're already borrowing against these data centers. They've already signed leases, and they're using those leases to go out and borrow money. For example, we've got this article in Reuters. Big Tech has nearly $1.1 trillion of lease obligations that they have already signed to rent data centers. And of those $1.1 trillion of lease obligations, only about a fifth of them actually show up on their balance sheet. Only $285 billion of actual lease liabilities was reported on the big five hyperscalers' balance sheet. That's Amazon, Microsoft, Meta, Google, and Oracle. All right, they've signed agreements for 1.1 trillion. They're only reporting 285 billion. But what are these data center operators doing? They're going into the market and they're borrowing against these lease obligations that big tech isn't reporting in their earnings. And they're borrowing from mostly the bond market, but also from private credit, using this paper as collateral. And case in point, Blackstone is out there pitching the biggest private credit deal in history, $36 billion. Blackstone is trying to raise in the private credit market in order to pay for chips for Anthropic. And keep in mind, this is 2 months after Apollo led what was up until then the biggest private credit deal in history, a $35 billion deal to buy chips for Google. To buy chips from Google for Anthropic, and that deal was backstopped by Broadcom, who's helping Google make the chips. Circular financing much? So take these three stories combined. All right, we're going to build 5 times as many data centers as we have power to power them. Okay, sure. We've already borrowed against them, and the debt is in private credit, this pit full of toxic sludge that investors are already clamoring over each other to get out of. But the people are like, back in the toxic sludge you go. We're gating withdrawals. They're never going to build this shit, guys. It's already too late. I've been warning about this for years. The damage has already been done. Could we please stop doing more damage? That's all I'm asking now. Like, just don't make it any worse. And of course, if they stop making it worse, that's when the bubble bursts and everything goes kablooey. Now, also going on this morning, we've got SpaceX has just reported for the first time. Their earnings they were pretty good. Starlink in particular. Starlink is making money hand over fist. Starlink is a great business. But AI just burned it all. They destroyed it all with XAI. Without AI, SpaceX would be a really good company. I might even invest in SpaceX if it wasn't for XAI. And of course, now XAI is SpaceX AI, or just, I don't know. It's all going to be under one company eventually anyway. But you're going to see in the charts the money that they're spending on Starlink, the money that they're spending on Starship, and then the money that they're spending on AI. My gripe with SpaceX all along has been it is no longer a space company. It's an AI company that plays with rockets on the side. Very impressive rockets, but it doesn't matter. It's not a space company. It's an AI company that loses money. We also got AMD earnings. They were pretty good. Revenue up 50%. Data center revenue up 107% year over year. But when your stock has already more than doubled for the year to date, no results are good enough. So that one is selling off after ripping yesterday. We've got Disney earnings came out as well. Parks and streaming were good. Movies kind of sucked for Disney. I guess a lot of people went to Disney World while they were here for the World Cup. The Houthis hit a tanker off of Yanbu yesterday, and oil was up about $1 on that news. The oil market continues to overreact to good news and underreact to bad news. But in particular, the city of Yanbu is very important because that is the end of that big east-west pipeline that the Saudis have been using to route their oil flow around the Arabian Peninsula instead of going through the Strait of Hormuz, loading it in the Red Sea. And then, of course, the Houthis said, we're not allowing you to cross the Bab el-Mandeb Strait. So they're still loading in Yanbu and they're heading north to go through the Suez Canal. And then the Houthis are saying, no, we're still going to blow you up in Yanbu anyway. And again, apparently that's good for $1 in the price of oil. An attack like that. Market continues to underreact to that. We've got gold and silver are ripping this morning. We're going to look at those charts. ADP private payrolls came out. They were worse than expected, down sharply from last week. We get the jobs numbers later this week. That's more important. And we got to talk about Jefferies. Jefferies, again, another receivables fraud, another factoring fraud over at Jefferies. The second in 3 days, the fifth this year. No, I'm not talking about Radiant World, the iron ore trader. That story is so Monday this week. Guys, there's another one. Jefferies will give money to freaking anybody who's got a piece of paper that says, some guy owes me billions. Trust me, bro. If you've got that, you can borrow money from Jefferies, apparently, who surely implements the most rigorous of risk management and due diligence processes, I'm sure, even though they've now lost money with First Brands, with Tricolor, with Market Financial Solutions, with Radiant World, with this latest one that we'll talk about at the end. Let's not forget that water cooler company. Yikes, the private credit space is a wretched hive of scum and villainy. Guys, we got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance. Don't forget the like button and the subscribe button for you new guys. You can come back tomorrow and have your coffee with the melon heads because we do this every day. S&P 500 is higher by 0.56%, 43 points in the green. Look, the market has just been ripping relentlessly since that Japan intervention last week. We had the best day in history in Korea, and ever since then, stocks have been pretty much up in a straight line. I don't think this is an accident. The governments are conspiring to rig markets higher, and so the markets are moving higher. The Dow is also higher by 260 points, 0.48% to the upside, and the NASDAQ is up 0.22%, 66 points to the upside. I don't have my Kospi chart ready to rock. I am remiss this morning. Let's bring this one up. South Korea was quiet yesterday, believe it or not. Stocks were higher by 3.76% for the index. And again, up 3.7%. That is a calm day in the South Korean market over here. Not much intraday swings, but it did open sharply higher. So South Korea, ever since about, well, what was it, Thursday, Friday last week, it's been pretty much marching straight up. We'll see if that rally has legs. The dollar is weaker this morning, down by 14 basis points, 99.73 on the Dixie. That is probably contributing to the run in metals, which we'll talk about in just a moment. Looking over at the bond market, we've got a mixed bag this morning. The 30-year yield, 5.169%. That is lower by 2 basis points. The 10-year yield is at 4.627, unchanged on the day. The 2-year yield is up by 1.5 at 4.210. And the 1 month is lower by almost 1 basis point, 3.675%. Looking over at commodities, the metals are looking good this morning. Spot gold up by $112, 2.75% higher after having a good showing yesterday. $4,189 an ounce for spot gold. Briefly hit a high of $42.13 this morning. Gold is moving this morning. Silver saying, hold my beer, $61.80 for spot silver. Back above $60, higher by $2.27, 3.83% in the green. Intraday high of 62.51. I like the shiny. We're going to look at those charts in just a second here. Copper higher by 0.65%. Platinum is down 1.3% after having a ripping day yesterday. The PGM metals did really good yesterday, but platinum is off this morning. Palladium is pretty much unchanged here, and crude oil is higher by not even a dime. $75.85 for WTI crude. The Houthis are blowing up tankers in Yanbu, and the market's like, okay, I'll give you a nickel for that one. All right, underreact much. But back to the metals. Let's take a look at the chart. Look at that candle in gold there this morning. This is interesting. All right, biggest move we've seen in gold, at least to the upside, since June 11th. And that move on June 11th was immediately following a 3-day wicked sell-off. So that was really just a dead cat bounce that eventually resumed lower anyway. So this one's kind of happening in a vacuum here. Nice big green candle for gold, threatening to recapture 4,200. And then in the silver chart is kind of interesting here because a couple of days ago I mentioned on the stream how it looked like silver was trying to put in a bottom around $54 and that it was important that we hold that level. I had circled the previous 2 times where that $54 level had acted as resistance. And of course, resistance becomes support. That support held, and now silver threatening to recapture 62. So look, I'm not ready to pile back into silver. I mean, this whole sell-off here, this things just got a little hot and heavy there, you think, maybe, in the silver market. I mean, we went from like $20 an ounce to $120 an ounce over a span of like a year and a half. Obviously, metals got a little ahead of itself. We had the mother of all sell-offs, and we've kind of been grinding lower ever since. So I'm not ready to like celebrate and say it's time to pile back into metals yet. I've been largely just an observer in the metals market for the last couple of months here. But that being said, some signs of life. The RSI was getting a little oversold. We're starting to see that moving higher. Again, congratulations to the stackers. Having a good morning. Looking over at Bitcoin, pretty much unchanged on the morning, $64,122 as priced on Coinbase. That's higher by about $80 here. All right, let's talk the main story this morning. Texas governor orders pause on new data center approvals pending an audit. This is big news here. I don't know how big this is. I don't know if Bloomberg or CNBC are talking about this or not, but they freaking should be because this should be the biggest story in the world right now. Texas Governor Greg Abbott has ordered a pause on approvals of new data center projects through the state's grid interconnection process, citing concerns that a surge in electricity demand could threaten reliability at a time when opposition to the projects is growing. You think maybe this might threaten reliability? Well, let's see what the numbers say, huh? The state is poised to become one of the world's largest data center hubs, with industry forecasts suggesting it could surpass Virginia by 2030, thanks to abundant land, energy supplies, and a business-friendly environment. However, local opposition to the facilities is rising due to their heavy use of energy and water, along with the pollution that stems from the power generation needed to run them. Last month, New York became the first state to impose a moratorium on large-scale data centers. And again, I've been talking about this all year, guys. There is almost universal opposition to data centers across the political spectrum. Deep blue New York, deep red Texas, both have moratoriums on data centers. Both sides of the aisle hate what they're doing. There's a very small segment of the population in San Francisco and big tech land and the MAGA people on the right who are just like, build more data centers. Yeah, we need more of them. Everybody else freaking hates these things. Why? Because they suck, because they're burning through our 401k and our IRA and on this big gamble on unproven technology. And if it works, they'll put us out of a job. No offense. Yeah. Of course people are opposed to these things. In a letter to the Public Utility Commission of Texas and grid operator ERCOT on Monday, Abbott directed the agencies to conduct an audit of all planned data centers seeking grid connections before any more facilities are allowed to move forward. Now, notice the qualifier here, seeking grid connections. We are seeing an increase in data centers that are increasingly turning to behind-the-meter power, which just basically means they're not even going to connect to the grid. They're just going to generate their own power on site. So this doesn't mean no more data centers at all. It just means no more grid connections. ERCOT is currently reviewing 474 gigawatts of proposed new electricity demand, more than 5 times the state's record peak load, the governor said, adding that 90% of the requests are from data centers. And guys, I'm sure there's got to be like a Christopher Lloyd, Dr. Brown meme in here, someone, 474 gigawatts, great Scott. Guys, that is 5 times the record peak load in the state, 91 gigawatts. All right, you're not going to ever get this done. Power grids don't 5x in size just because some a-hole in Silicon Valley said a thing on a podcast. All right, I don't care how many guys in leather jackets and turtlenecks stand up at a TED Talk and talk about the future and oh my God, I vibe coded a girlfriend for myself and therefore this is a multi-trillion-dollar industry. Not if there's no juice. All right, and 474 gigawatts, this is obscene. It is obscene how many of these things they've proposed. And look, guys, they're already borrowing against these things as if it's already done. AI data center race builds $1 trillion lease burden for big tech. That is trillion with a T, from companies that are already negative in free cash flow. Microsoft, Meta, Oracle, Amazon, and Alphabet have committed about $1.09 trillion in future payments under leases that have not yet begun, mostly for data centers needed to power artificial intelligence boom. The commitment shows that a substantial part of big tech spending spree has already been locked in without yet appearing as debt-like lease liabilities on company balance sheets. All right. If demand for AI computing continues to surge, the facilities will underpin the next phase of cloud growth. If it does not, the companies could be left paying for vast amounts of costly, long-lived capacity that is difficult to shed. The total is nearly 4 times the roughly $285 billion of lease liabilities already recognized on the company's balance sheets, according to company filings compiled by Reuters. And then this chart here shows, here's the uncommenced lease obligations, and then here's the recognized lease liabilities for each of the 5 platforms. Microsoft in particular, $329 billion in uncommenced lease commitments. All right, so look, here's the thing. Number one, the companies are hiding how much money they're going to owe. They're only reporting $285 billion when really it's $1.1 trillion. That's these 5 companies combined. Number two, here's the other thing. The reason why they're not reporting these as their liabilities is because of something called construction in progress. These data centers are not done yet. And so because they're not done, they don't have to actually start paying these leases. But NVIDIA has already sold the chips and already booked them as revenue. Even though they haven't been installed, haven't been turned on, they've already made their money. And so, they need another 474 gigawatts of unfinished data centers in Texas in order to maintain those explosive growth numbers, which is never going to freaking happen. Guys, this is the law of large numbers catching up to this bubble. It's never going to freaking happen. There's no power, like all of these uncommenced lease commitments, which they've already said, we're going to rent these GPUs. They can never be switched on. There's no power for them. Now, here's the other thing. They're already borrowing against that. Blackstone has pitched mega debt package for Anthropic chip deal, the second in 2 months. Blackstone has held early discussions with investors to gauge interest in a second mega debt package to finance Anthropic's use of chips from Alphabet's Google. One initial proposal was for at least $36 billion of debt, according to people with knowledge of the matter. The details, including the size and structure, and even whether Blackstone will ultimately lead the financing, are being discussed and may change, the people said, asking not to be identified because they're not authorized to speak. If it were finalized at around that size, the deal would exceed the $35 billion of debt that was lined up by Apollo and Blackstone just 2 months ago to fund Anthropic's lease of Google's custom chips. Broadcom had to backstop that deal, by the way. That package was one of the biggest private credit transactions in history. As Silicon Valley races to build AI infrastructure, leading firms have struck complicated and often circular deals with one another in a bid to secure access. Google was one of Anthropic's earliest investors, repeatedly buying equity and now increasingly backstopping the financing that underpins data centers for the startup. All right, so they can't turn them on. They owe $1 trillion in these leases. They're having to backstop the chip sales. Private credit, leading two of the biggest private credit transactions in history in the span of 2 months. Guys, the top is in this bubble. The numbers are now too big. They have borrowed all the money in the world. They have used all the power in the world, and they're still telling us we're going to build even more. How? With what money? With what power? There isn't any more. And it doesn't just appear, no matter if you click your heels together and close your eyes, it doesn't pump electrons. Meanwhile, SpaceX's AI splurge puts damper on debut earnings after IPO. SpaceX fell 12% in pre-market trading after the company disclosed higher than expected spending on its AI business, overshadowing an inaugural quarterly report that broadly surpassed Wall Street forecasts. It's worth pointing out that SpaceX had ripped like 9-10% yesterday before falling 12% in pre-market trading. So it just basically like wiped out all the gains from yesterday. Shares of Musk's rocket, satellite, and AI conglomerate tumbled in the U.S. after it said capital spending jumped to $18.4 billion in the second quarter. Stop spending on Capex. Cut the damn Capex. The message is pretty clear here. We expect the cadence of AI development to improve dramatically, Musk told analysts on a conference call. SpaceX topped estimates for revenue and AI losses, and executives fleshed out ambitious plans to use its Starlink network to compete directly with the largest U.S. mobile phone carriers. Now, that's interesting, the thing about Starlink and the mobile phone carriers. I don't know if you guys remember, a few weeks ago, we talked about the EchoStar bankruptcy. EchoStar owns Dish TV and DirecTV. And the biggest asset in that bankruptcy is the bandwidth the spectrum that they currently control. So if Starlink is going to become a new mobile phone carrier, they're going to need bandwidth to put all that on. I suspect SpaceX is going to end up buying that EchoStar bandwidth out of auction, and then whatever SpaceX pays for that is what will be used to pay back the people that DirecTV owed money to. SpaceX's results capped a roller coaster ride since the company raised $86 billion in the largest stock market debut of all time, followed by like a $25 billion bond offering a week later. Shares have since plunged in a bout of post-IPO volatility and a broader AI sell-off, erasing more than $1 trillion in market value from their peak, along with Musk's status as the world's first trillionaire. Now look at this chart here, guys. This is where the Capex at SpaceX is going. All right, the orange here, that is their second quarter of 2025 from a year ago. The black is what it was last quarter, and then this gray is what they spent in their most recent quarter. All right, so you've got, here's their spending on AI, here's their spending on connectivity, and here's their spending on space. So with their space Capex, that's like basically what they're spending on Starship, which is their big project. The last launch went pretty well. It splashed down in the Indian Ocean. It's currently being towed back home. They spent about $1.2 billion on space. They also spent just under $1.4 billion in Capex on expanding Starlink. Those are their two big core businesses. And then they spent $15.8 billion on AI. And this is this chart. Get a good look at it. If you bought SpaceX because the rockets are cool, you need to understand what you really own, guys. All right. If it was just these two here, this is a great company. Starlink makes money. The launch business loses money, but it's getting better. All right. Those two businesses in a vacuum, I'm right there with you. I would buy this company. But this is what SpaceX really is, an AI company. Adding to the sense of uncertainty, more than $100 billion worth of stock becomes eligible for sale for the first time later this week. Oh, that's right, the IPO lockup, that's coming to an end, potentially putting more downward pressure on the price. SpaceX reported revenue of $7.8 billion. That's greater than the $6.8 billion analysts polled by Bloomberg estimated. The company said it lost 9 cents a share for the quarter, less than the 24-cent loss that analysts had forecast. And again, most of that is because Starlink is actually making them a lot of money. But SpaceX is not a Starlink business. It's an AI company. Stock down 12.1%, $110 a share, well below the $125 IPO price. What did this thing go up to, like 225 immediately after the IPO? Now down almost $15 today. Meanwhile, AMD's revenue climbs 50% and data center sales doubled, but the stock is down because no results would have been good enough for AMD. AMD reported second quarter earnings on Tuesday that beat expectations. The stock slumped and extended trading after rising during regular trading hours. EPS of $1.66 beat estimates of $1.62. Revenue of $11.54 billion versus $11.28 billion expected, so a beat on the top and the bottom line. Overall, AMD revenue climbed 50% from $7.6 billion a year ago. AMD's data center unit is what's driving the company's growth. Data center sales were $6.7 billion, up 107% on an annual basis, which the company attributed to central processing unit and graphics processing unit sales. The chipmaker stock has nearly tripled over the past year, both on optimism that its AI chips, branded Instinct, which will take a meaningful amount of growing market from NVIDIA, as well as the resurgence of the CPU, which AMD sells under the brand name of EPYC, which AI experts now say is an essential component for running agents. By the way, the whole thing that AMD is going to somehow take market share from NVIDIA, yeah, SpaceX in their earnings yesterday announced that they were going to be building exclusively on NVIDIA chips from now on. So if AMD is going to capture market share, it's not going to be from SpaceX. AMD said it expects about $13 billion in revenue for the current quarter, plus or minus $300 million, versus expectations of $12.5 billion. Some had been looking for guidance as high as $14 billion. So maybe that guidance was a little light. It's possible that's contributing to the sell-off, although at the bell here, AMD is recovering, now down 4.6%. This thing was down 7-8% a few minutes ago here. So some dip buying going on at the opening bell for AMD. Meanwhile, Disney's streaming and parks drive third quarter profit growth. It was actually a pretty good quarter for Disney here. Walt Disney's profit beat estimates in the company's fiscal third quarter, driven by soaring income from its entertainment division and the resilience of its theme parks in California and Florida. Disney's EPS came in at $2.06, the company reported, comfortably beating estimates of $1.86 compiled by Bloomberg. Operating income of $5.56 billion beat forecasts of $5.24 billion. Second straight quarter, better than expected profitability for the new CEO, Josh D'Amaro, who took over for Bob Iger in March. The entertainment division, led by Alan Bergman, that houses Disney's film studio and flagship Disney Plus streaming service, profit rose 64%, driven by subscriptions and a double-digit margin in the online video business that helped offset a mixed quarter at the box office. The Devil Wears Prada 2 and Toy Story 5 were blowout successes, while Star Wars The Mandalorian and Grogu underperformed. The current quarter will also be impacted by the performance of live-action Moana remake, coming in below expectations, Disney warned. At Disney's experiences arm, led by Thomas Maslom, that includes parks and cruises, profit rose 20% to $3.02 billion, driven by healthy attendance and spending at its parks in the U.S. In Orlando, Walt Disney World Resort had a standout quarter, Disney said in its earnings. So it looks like while people were here for the World Cup, they did your quintessential American tourism thing and they went to Disney World. But it's also interesting to point out here the performance contrasts with rival Comcast Universal Resorts in Orlando, where demand slowed in June. So people came to the U.S. and they went to Disney World. They did not go to Universal Studios, which is right next door. Disney stock having a good morning, up 2.65%, trading just above $100, higher by about $2.50. Meanwhile, oil prices move higher, barely, after Yemen's Iran-backed Houthis claim Saudi tanker strike. Crude prices rebounded on Wednesday after Yemen's Iran-backed Houthi militants claimed they had struck a Saudi Arabian tanker in the Red Sea. Let's see here. The Iranian-aligned Houthis said they hit the tanker with a missile near the coast of Yanbu, a major port for Saudi crude oil exports. The reported strike and subsequent rebound in oil prices rattled markets and appeared to sour hopes of a potential ceasefire deal in the Middle East. The Houthis have been increasingly targeting boats and infrastructure on the northern end of the Red Sea recently as the oil tries to get around the Bab el-Mandeb Strait. And as you can see here, guys, oil 76.23, higher by $1.10. I mean, oil's barely reacting to this. Again, the bias is to the downside on the news flow here for some reason. All right, U.S. ADP, private employment change. This is the less important jobs number. This is the private sector one. The government's number comes out on Friday. But this can give us insight into what we might see on Friday. Private businesses in the U.S. added 44,000 jobs in the month of July. That is lower than the 70,000 the market was expecting and lower than the downwardly revised 95,000 from the month of June. This was originally reported as 98,000. Again, guys, this is private data here. The government doesn't play any role in collecting of this data. But at least according to this, the job market weakened somewhat in July, perhaps after the effects of the World Cup wore off. All right, last one of the day. Jefferies gets new evidence of fake invoices at troubled fund, Bloomberg News reports. Another Jefferies story this morning. This is not the one from 2 days ago. This is a different one. Jefferies has been told that some of the invoices underpinning its financing to an iron ore trader called Sapphire Minmetals Corp. are not genuine, Bloomberg reported on Tuesday. The discovery came after Jefferies checked the veracity of the invoices with Vital Group. As a further blow to the U.S. bank and its Point Bonita fund, the report added, citing people familiar with the matter. Jefferies, Vital, and Sapphire did not respond to requests for comments. Point Bonita made headlines last year after Jefferies disclosed that the fund had millions of dollars in exposure to bankrupt auto parts maker First Brands Group. The episode put receivables finance under greater investor scrutiny, even though it is generally considered a low-risk form of lending because loans are backed by invoices. Jefferies has been checking the documents underpinning the Point Bonita fund's financing to both Radiant World and Sapphire Minmetals in recent weeks, Bloomberg reported. And that Radiant World, that's the story from 2 days ago where several of the biggest commodities trading houses in the world said, we're not willing to do business with Radiant World anymore because of receivables fraud. Jefferies has a $300 million exposure to them. Jefferies also lost a bunch of money with First Brands. They lost a bunch of money with Tricolor. They lost a bunch of money with Water Station Management, and they lost a bunch of money with Market Financial Solutions. Now you can add Sapphire Minmetals to that list. But again, guys, private credit, they do very serious risk modeling, and they've got great algorithms. And, this firm of 15 people somehow did all the DD required to make sure that they weren't losing other people's money. Jefferies stock is up this morning. It's up. Okay. $56.28 for Jefferies. Now, again, this is the Point Bonita Capital. This is a hedge fund that Jefferies runs. So maybe the losses are somehow siloed and contained within Point Bonita, and Jefferies proper, the larger parent company, won't lose all that money. I mean, maybe it's just Jefferies clients that are going to lose all that money, and maybe that's somehow good news for the stock. I don't know. But it seems like we've got another isolated event. Sapphire Minmetals. Throw it on the pile of other isolated events. Boy, a lot of people seem very isolated, don't they? Hey, I just want to say thanks everybody for having your coffee with the Melon Eds this morning. Don't forget the like button, and you new guys, hit that hit that subscribe button for the algo so I can see you tomorrow. Thank you also to my members on Patreon, YouTube memberships, and Buy Me a Coffee for supporting the channel. Appreciate that very much. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.